Hello, this is the review session for Chapter 9, and Chapter 9 speaks about investment criteria. And for this chapter, I know that they covered a lot of different investment criteria that are used: net present value, payback, average accounting return, internal rate of return, profitability index, and capital budgeting. The two terms that I will concentrate on for this review session are basically the NPV, net present value, and the IRR, the internal rate of return. A couple of reasons why I decide to focus on these two terms for this review session. Number one, these are the most used investment criteria in the finance world when you talk about capital budgeting. Number one. Number two, if you have a deep understanding for net present value and internal rate of return, you will, in essence, understand the basis and the basics of corporate finance, capital budgeting, and when they talk about cash flow and required rate of return, you will have a better understanding and a better appreciation of finance if you understand these two investment criteria that I'm going to talk about momentarily. So, number one, why do we talk about capital budgeting criterias? What do we use tools to understand which project we should choose or which piece of material we should choose over the next one? Well, you need to be able to quantify the reasoning behind going into project A versus going into project B. And the only one of the best tools to do that will be your NPV and your IRR. I will talk about that momentarily. Also, we need to ask ourselves the following questions when we look at when we look at a project when it comes to capital budgeting. Does the decision that you make adjust for time value of money, right? Net present value, time value of money. Does the decision rule adjust for risks in the market, right? The risks in the market, the riskier a project is, the higher the return should be, risk reward, right? If your project is very risky, the money you should be getting back, the return you should be getting back should be higher than any other investments out there with the low level of risk, right? Does the decision rule provide information on whether you are creating wealth or value for the firm or wealth for the shareholders? Well, my friends, let me tell you, if NPV is positive, you're creating wealth for the shareholders. And we will see how you can utilize that tool to be able to understand how you are increasing the value for the shareholders, how that you are creating value for the firm, because you're spending your investment, you're investing money into a project. Therefore, you should be getting money back for that investment you've made. And the money that you're getting back, the return that you're getting back, the rate of return that you're getting back should be higher than anything out there with the same level of risk or lower, right? Because if you put your money in a CD at a bank, the level of risk are very low. That is why right now in the market, you're not getting pretty much a high rate of return on that money you put in a savings account at a bank. However, if you go out and you purchase a share of a company or you made some risky investments, you should be compensated for that level of risk that you're taking. Okay, so let's get back on topic right now. Net present value. It's very simple to explain to you net present value. The purpose of using this tool is to know if you should accept whoops, excuse me, you should accept or reject a project. Okay, the reason why you're using these tools is to know if you should accept or reject a project, right? So let's say you have a project that you're studying. Okay, you have a project that you're studying, and you know that you will have to outlay some cash for this project, and the project has a certain level of payments that it's giving you on a yearly basis, right? We'll count the period as 1, 2, 3, 4, the 5. Okay, so you're investing money in time zero, You're investing money in time zero, and you're hoping that every single year that investment will pay you back. All right, that investment will pay you back. Therefore, you want to know if you should go into that investment or not. So we'll use NPV to calculate that. Okay, so to invest in this project, you will need to you would need to outlay or put an outflow of cash of $10,000. Okay, to have this investment or to invest into this project, you need $10,000. Okay, now when you analyze this project, you realize that the cash inflows, the money that you will be making from this project, are as follow. Right, year one you'll be making 2,500. Year two you'll be making $4,000. Year three you'll be making $5,000. Year four, you'll be making $3,000. In year five, you'll be making $1,000, right? So year one, you're making 2,500. Year two, you're making 4,000. Year three, you're making 5,000. Year four, you're making 3,000. Year five, you're making 1,000. Now you want to know if this is a good project or not. You don't know. You want to know based on a required rate of return of 6%. All right. Required rate of return of 6%. Is this a good project to go into? Is this a good project? Now, how do we calculate the net present value of this project into finding out if it is a good project or not? Okay, so we said year zero, you're spending 10K to get into this project. Year one, you're making 2.5K. Year two, you're making 4K. Year three, you're making 5K. Year four, you're making 3K. And year five, you're making $1,000. Okay. Now we're going to be the question that we're asking ourselves: do we accept or do we reject this project? Well, first of all, we need to find out the formula for net present value. The formula for net present value is simply your cash outflow plus the present value of all your cash outflow. Oh, sorry, all your cash inflows. Okay, so that's simply $10,000 plus, right? The present value of all your cash inflows. Therefore, the present value at time one is 1.1 plus 6% to the first power. Cash flow at time two is 4,000 over 1 plus 6% to the second power. Present value, right? Time three is 5K over 1 plus 6% to the third power. Time four is 3K, 1 plus 6% to the fourth power. And time five is 1K over 1 plus 6% to the fifth power. Why we're using that formula? It's simple, because what is the formula of present value? Present value is simply your payments over 1 plus R to the n power. This is the formula that we've utilized here, 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 and here to find out the present value of the cash inflows. Well, if we're calculating this, it will tell you that the present value of the net present value of this project is simply minus 10,000, which is your cash outflow, plus 13,239, which is your cash inflows. Well, the project is your net present value on the project is $3,239, right? $3,239. And the rule for NPV, it says that if your NPV is greater than zero, then you're creating wealth for the company, or you're creating wealth for the shareholders. Therefore, based on the information given on this project, and based on the net present value that is greater than zero, we accept this project. Okay, so anytime your NPV is greater than zero, you accept the project. Simple as that. Anytime your NPV is greater than 0, you accept the project. As simple as that. There's no other way around it. There's no other way to describe NPV. Every single time that your NPV is positive, you're creating wealth for the shareholders. As simple as that. Sorry about that. There it is. So anytime that your NPV is greater than 0, you're creating wealth for the shareholders, and that is the lesson about NPV. I'm losing my screen here. I don't know what's going on. Give me a second. All right, second portion of our video, we'll cover IRR. IRR, this is the most important alternative to NPV, right? The IRR is the rate that will get the NPV equal to 0. All right. So here, the thought process is if your IRR is greater than your required rate of return, then you accept the project, right? If your IRR is greater than the required rate of return, you accept the project. For our example here, right, this is the required rate of return. If we calculate IRR, right, and IRR is greater than 6%, then we accept the project. Okay, so if your rate of return is less than your IRR, if your IRR is greater than your rate of return, then you accept the project. It is often used in practice and is intuitively appealing because you're talking about percentages, right, as opposed to numbers. If I tell you, oh, on project A, the NPV is 3,000, that really doesn't tell me anything if you're not really a finance guru. But if I tell you that the internal rate of return of the project is 15%, and you know that the required rate of return that your investor were asking about was 10%, then you know if 15%, which is the return on the project, is greater than the 10% that the investors were looking for, the investor will invest in your project, right? It is entirely based on estimated cash flow, and it is independent of interest rate found elsewhere. Okay, so the IRR only concentrates itself on the estimated cash flow, and it does not look at interest rate found elsewhere. Okay. Now, by definition, the IRR is the return that makes the NPV equals to 0. By definition, it's the return that makes the NPV equals to 0. Okay, that's what I said here. Accept the project if the IRR is greater than the required rate of return. We always accept the project if it is greater than the required rate of return. Okay, it is very simple to calculate your IRR based with a calculator. Like I said, we've spoken about the keys on chapter 7. The keys are the same. You will have cash outflows, which will be your cash outflows are CF0. Sorry, I made a comment about chapter 7. These are completely different. Your IRR calculator keys can be found on your PowerPoint presentation about chapter 9. Please look at your PowerPoint presentation. You will find exactly what keys you should use in order to compute for your IRR. Now, the difference between IRR, the relationship between IRR and NPV, if you get a project where your IRR, you have two projects where your IRRs are different and your NPVs are different, right? You will always choose the project with the higher NPV. Always choose the project with the highest NPV. Why? Because NPV always trumps any other criteria that are out there. Therefore, if you're computing, if you have on your exams, they give you two projects with cash inflows and cash outflows, where your IRR and your NPVs are different for both projects, you will choose the project with the highest NPV. The project with the highest NPV will always be the one chosen. Okay, why? Because the NPV directly measures the increase in value to the firm. The NPV, um, a positive a positive NPV equals to wealth creation. Wealth creation for the company or the shareholders. Whenever there is a conflict between NPV and another decision rule, you should always choose NPV. All right. Whenever there is a conflict between NPV and another decision or another criteria, always choose NPV over any other decision rules that are out there, because NPV um, indicates wealth creation for the company and for the shareholders. Okay. So in essence, net present value is the difference between your cash inflows and cash outflows. You will always choose the project with the positive NPV, and if you have two positive NPV, you just choose the one with the highest NPV. Okay, your internal rate of return is the discount rate that makes your NPV equals to 0. Now, if your IRR is greater than the required rate of return, you'd select the project. Okay, if you have two projects or two different pieces of equipment that you're analyzing if you should buy or not, and you have to select the one with the highest NPV. If you calculate NPV and IRR for both projects, the one with the highest NPV is the one you should choose always. Always. All right. Now, I must say I've covered NPV and IRR. I decided to focus on these two. However, it is your responsibility to review this video. It is your responsibility to read the book, and it is your responsibility to go through the PowerPoint presentation in order to get a greater understanding of the concept on this chapter before you take the exam number 2 and or the final. Thank you very much. Have a good one.